So friends, a very warm welcome to all respected valuers, engineers, architects, chartered accountants, real estate professionals, students, and valuation enthusiasts. We are delighted to introduce you to the Registered Valuers Club, an exclusively YouTube platform powered by Council of Engineers and Valuers, CEV Group, one of India's most trusted names in the professional valuation fraternity. In today's rapidly evolving financial and regulatory environment, valuation professionals play a pivotal role in maintaining economic transparency and corporate integrity. The Registered Valuers Club has been created with a powerful mission to educate, empower, and evaluate valuers across the nation. Here you will find expert discussions and interpretations on valuation standards, case studies, and practical insights from industry leaders, latest updates on IBBI, MCA, and other regulatory frameworks, guidelines on examination, eligibility, compliances, and career growth, field-based knowledge on land and building, plant and machinery, and securities or financial assets valuations. Webinars, interviews, frequently asked questions, and more educational resources. Our goal is to build a strong, informed, and united community of valuation professionals who uphold competence, ethics, and excellence in every assignment. Friends, whether you are preparing to become an IBBI registered valuer, looking to enhance your professional capabilities, or interested in staying ahead with current valuation practices, this channel is your learning hub. So make sure to subscribe, like, and share the knowledge and with others who aspire to grow in this profession. Together, let us strengthen the foundation of India's valuation ecosystem. Thank you and welcome to the Registered Valuers Club, where valuers rise, lead, and transform. Here we bring you expert guidance for IBBI registered valuer aspirants, latest regulatory updates, IBBI, MCA, RBI, and others, practical case studies with valuation methodologies, professional insights from industry leaders, training on land and building, plant and machinery, and securities or financial asset valuations, career support, frequently asked questions, and compliance knowledge. Our mission is to educate, uplift, and connect the valuation fraternity through high quality, authentic, and practical content. Whether you are a student or emerging valuer or an experienced professional, this channel is your gateway to continuous growth and excellence in valuation. So subscribe now and join India's fastest growing community of valuers. Together, let us build a stronger, compliant, and future-ready valuation ecosystem. Don't forget to like, comment, and subscribe our official YouTube channel, Registered Valuers Club. And you can also find the related videos and articles and other related informative material on our official website, that is www.cevnews.in. You can log in and you can also subscribe this website, and all the contents will be provided to you free of cost on your mobile screen or laptop or desktop. And if you feel any difficulty, question, or query, you are always welcome to call me on 9041263607 on my personal mobile number.
Registered valuer exam important concepts. First, I will introduce myself. I am Khandu, Ghavane. I am ME Civil, MBA Financial Management, retired executive engineer from MIDC. I have also worked with NHI on Delhi Mumbai Expressway. I have prepared these PPTs as a course material for IBBI registered valuer examination for asset class land and building. Also, I have prepared another presentation for asset class securities or financial assets. There is about 30 to 40% common syllabus in both the asset class, covering IBBI examination, valuer, ethics, code of conduct, then laws, economical concepts, value of money, valuation concepts. Likewise, this presentation is divided in 4 parts. First part is important concepts, then case studies, then most important from exam point of view, MCQ data bank, and then use of open office, because in IBBI valuer examination it is online examination and Excel is not provided. Open office software is provided for examination. The open office is pre-licensed software available for downloading. It works in Windows laptops, Apple laptops, and in smartphones. So when we are studying, use open office, because in exam we have to use open office and the time is limited. There are 87 questions of 100 marks in 2 hours. So speed is very important. While solving the questions and case studies, this case study may be solved by many methods. So in exam we should go for the quickest method so that we can save our time and complete the exam in given time. I will I will explain while solving the basic or the theoretical approach of that concept in open office by tabular calculations, and then by using open office syntax formula or that command. So how we can quickly use that syntax and get result, both the things simultaneously I will explain. So moving forward, this presentation is of land and building. This is general syllabus covering microeconomics, bookkeeping, accountancy, laws in general, statistics, environmental issues, professional and business ethics and standards, laws related to real estate like RERA Act, valuation of real estate, then approaches. There are 3 approaches: income approach, market approach, and cost approach. As per the asset class and the details available, we shall decide which approach we shall have to use. In many cases, we shall have to use more than one approach and find out the value. After finding the value, the valuer can decide to propose the value by which approach, or by giving weightages to these outcomes by these various methods, the valuer can propose the value. Then principles of insurance and loss assessment. This insurance part is in both the syllabus, in asset class land and building and in securities or financial assets, but mainly the exam questions come in land and building. I have cleared my examination last year in first attempt after within 1 week after completion the 50-hour course from CEV IAF Jalandhar, Punjab. Then the syllabus consists report writing, important case laws. This case laws gives the principles of valuation. So these are very important. There is coverage of 2 marks and then case studies. Case studies of 26 marks. The overview of presentation is foundations of value. What is cost, price, value? Then approaches, its purposes and standards and reconciliation. So who is eligible? As we all are aware that for land and building, civil engineer, architect, town planners can register and attempt this exam and practice as a valuer. The principles of economics, microeconomics and macroeconomics. As the word emphasizes, macro is broad level, country level, and this micro is micro level economics. So these principles we shall have to study. We will see one by one thereafter. Then there is accounting system. Worldwide we are following double entry bookkeeping system, and in India also. This nowadays due to introduction of the computers in all field to the extent of almost 100%, we are using softwares, Tally and many more. So but these basic fundamentals we have to study from exam point of view. Then the cash flows, account statements, balance sheet, profit and loss account. These accounting principles we have to study. Then break-even analysis. Break-even analysis is where the fixed cost is recovered and the businessman is a position at low, no loss, no profit position. The laws and environmental issues. The important environmental legislations, the Water Act 1974, Air Act 1981 and Environment Protection Act EPA 1986. In this presentation, these other things can be read, and we are the professionals. We have already qualified our graduation level and working as a professional in various fields. So you can read and study this theoretical part. The important concepts I am covering is case studies and MCQ data bank. Professional conduct and ethics. So as per IBBI regulations, the professional conducts and ethics are given. You should download and have print out and read this thoroughly and write at least once, so that you will be conversant with each and every word of this rules. So there are questions, 2-3 questions from these rules. There is Transfer of Property Act, and then there is right to fair compensation and transparency in land acquisition, rehabilitation, and resettlement. RFCTLR Act, which is enacted in 2013, and land acquisition matters all over the country are decided by this act. It is a replacement of the Land Acquisition Act 1894 and subsequently 1984. Then the Factories Act is safety, welfare of workers, water, ventilation, crashes, working hours, all this is covered in Factories Act. RERA Act, this is a very important act in India for real estate, because India is urbanizing very fastly, and this real estate business is very big and related to everyone's day-to-day life and life as a whole, because whole of the investment invested in this business, in this house by many of our families. Then there is Rent Control Act. So there are rent control acts to safeguard the tenants from the increasing rents. So there are state level rent control acts like Maharashtra Rent Control Act 1999, the Bombay Rents Hotel Lodging House Rates Control Act 1947, likewise. So the important is valuation, and valuation is a judgment by a valuer. So it is an estimated worth derived through objective calculation of future benefits. So, but even though it is a judgment, but it is supported with the documentary proof as per set guidelines. So whenever this valuation report is objected from its value point of view, from lower side or upper side, so the valuer shall be in position to defend his valuation report. Otherwise, huge penalties are given in the law. Penalties in terms of amount, and in imprisonment also penalty also given. The basic elements of value are utility, scarcity, demand, transferability. This income approach, this flow is given. Then when we are doing valuation, some adjustments shall be done when we are using market approach, because every property is different in its attributes. So some adjustments depending upon its attributes shall be made. The most important valuation approach in land and building, or these fixed assets or tangible assets, is depreciated replacement cost. So this land and building valuers covers mainly the buildings and lands. So this depreciated replacement cost method is mostly used in valuations. This market value, as we are aware that it is in the free market, in arm's length transactions, means there is no compulsion, time constraint or like that, and it is an open market value. It is market value. um, there is question uh, which is twisted in different way, and the most of the time the answer of the alternatives is market value. So concentrate always on market value while deciding other values. The liquidation value is when there is no any other mean but to liquidate, and also time constraint manner. So this liquidation value in CIRP, both the values are asked from the valuer, the, as per the going concern value or fair value and liquidation value. Then mortgage and distress value. For securing bank loan, banks may apply margin haircut over market value. Forced sale value. Then replacement and restatement value. Replacement means by using modern equipment, modern technology, keeping the purpose same, we can replace the structure or the thing. And reinstatement means like historical structures, making it in its original condition. So that is reinstatement value. Then highest and best use. This in a going concern business, the highest and best use, that is uh, for that user. So this valuation shall be done as per this highest and best use. Basic elements of value, as we are know, when is there a value, whenever there is demand and supply. So whenever demand, it has value, it should have some utility, and it is a scarce resource. There is supply matching demand, but this scarcity is also a basic element. And transferability, the asset should be transferable. So this dust, demand, utility, scarcity and transferability, these are the basic elements of value. Factors affecting value: physical, economic, legal, social, environmental. This is already we have covered. Then in cost estimation, cost approach, there are various methods: plinth area rate, cube area rate, unit comparison method. So these are the cost estimation. Then there is deterioration, obsolescence. As the life passes, there is depreciation or life of structure, useful life of structure. There is depreciation. It is determined with straight line method, which is known as engineer's method, or WDV method. It is known as income tax method or accountant's method. And these obsolescences are, there is permanent loss of structure, some part of the structure or the quality of the structure. So these obsolescences are to be deducted. The obsolescences are functional obsolescences, physical obsolescences, economic obsolescences. Economic obsolescence is external to the property. These are the various terminologies: physical life, economic life, legal life, effective life, remaining life, total life. So this is example of cost approach. Market approach and income approach. The cost approach, as name suggests, it is based on cost of construction or cost of reproduction or replacement, less depreciation as per life of the asset or structure. When this approach is used when comparable data is unavailable, specialized properties like temple, school, and for insurance purposes. Because in insurance we have to give the insurer reimburses the claim for reinstatement of the property. Then second approach is market approach, based on analysis of recent comparable sales transactions in market, and in that locality the comparable sales of that assets are identified during the recent period, and based on that, by making certain adjustments on plus minus side depending upon the attributes of the assets, the value is decided. It is used when active market exists, residential and commercial properties sales instances are available. Third approach is income approach. This income approach is for income generating properties like petrol pump, cinema halls. The principle of substitution is that a rational buyer will not pay more for a property than the cost of acquiring an equivalent substitute. When the cost approach is used, specialized single purpose properties, hospitals, schools, places of worship, no active market with comparable sales, insurance, reinstatement value assessment, new recently constructed buildings, government and public buildings, industrial properties, factories, warehouses, owner occupied bungalows. In owner occupied bungalow or property, land is assessed by market and building by its cost. The key components are, there are two components, land value and building value. The land value by market approach and building value by cost approach. In that, reproduction cost, replacement cost. So generally replacement cost is used and depreciation is deducted. So the final value is land plus depreciated replacement cost, land value plus depreciated replacement cost, DRC. This reproduction cost and replacement cost, it is already seen in first presentation. The methods of cost estimation. The cost is arrived by various ways. The most accurate way is by detailed estimate. There are schedule operates. Previously, the schedule operates were district schedule operates for each district in Maharashtra. Then this district concept has gone, and there are now the state level schedule operates. Those are published by Public Works Department. Then there are CPWD rates at center level, Delhi. There are CPWD schedule operates. So by using these schedule operates and estimating the itemized quantities of various items, the rates are arrived, and it is the most accurate method. Most of the tenders are floated by using estimates based on this approach in government organizations. So this is the most accurate approach. Then the most common is plinth area rate or block rate. The circle rates or block rates are published in PWD, and by adopting these block rates are also given in ready reckoner rates also. So by using this plinth area rate, commonly the estimation is done. For large structures, volumetric basis is used. Then special properties unit comparison method. Cost per functional unit, cost per bed for hospital, cost per seat for cinema, and this is useful for feasibility studies. Depreciation in the cost approach. This we have to find out the DRC, depreciated replacement cost. Then this depreciation, that is general wear and tear by use due to weathering, Then there are some obsolences. The functional obsolescence, economic obsolescence. Economic obsolences are external, that is market conditions beyond property boundary, airport noise, industry pollution, decline in the neighborhood, and this economic obsolescence is always incurable, external to the property. And functional obsolescence include outdated design layout. As time passes, we, the society in general, are progressing by advent of new technologies, new materials, new concepts, and the expectations about living. The outdated design layouts, poor floor planning, low ceiling height, excess capacity or deficiency, and these functional obsolescence to some extent are curable, and those are curable and incurable also. Likewise, internal furniture finishes can be changed, but the arrangement and height like that cannot be changed. So those are partly curable, partly incurable. So the depreciated replacement cost works out to replacement cost new minus physical deterioration, that is depreciation, functional obsolescence, economic obsolescence. There are various methods of depreciation, but in this valuation of land and building, generally we are using straight line method. It is known as engineer's method. And in income tax purposes, WDV, written down value method, diminishing balance method, it is also known as CH method. So this in straight line method, annual depreciation is replacement cost new minus scrap or salvage value divided by total life. It is very simple. In WDV method, a certain percentage is deducted every year. This percentage is worked out as 1 by n as per life of the structure. If there is some salvage value, then salvage value divided by cost. 1 minus salvage value divided by cost raised to 1 upon n. This is per yearly percentage depreciation, and based on that, the each year depreciation on reducing diminishing balance, it is worked out. Then this observed condition method, as per physical observation condition of the structure, its maintenance, it should be judicially decided. Then there is sinking fund method of depreciation. Here this sinking fund gets accumulated from scratch or zero, so the depreciation in sinking fund method is less, and in WDV it is more, because base on which it is calculated. In WDV there is large base which gets diminishing over period, and in sinking fund method it gets accumulated, some gets accumulated, so the depreciation increases over period of time in sinking fund method. There are various life of building. These are terms: physical life, that means physically capable of standing and being used, depends on quality of construction, maintenance, climate. This generally RC structures have life 60 to 100 years. Presently it is about 30 to 50 years, but now the high grade concrete is being used. Then there is Nivan formwork construction, that all the walls are RCC, and in such type of structures it is expected that the life will be about 100 years, 60 to 100 years. Then this economic life, the structure for period economically used. This is economic life. Legal life, as per lease permission license, the legal remaining life. Effective age, as per buildings conditions. Then second approach is market approach, sales comparison approach. The value of property is indicated by the prices paid for comparable properties in the same market under similar conditions. So this is sales comparison. The principle is based on economic principle of substitution. A buyer would not pay more than the cost of acquiring a comparable substitute property in the same market. The data is sourced from registered sale deeds, sub-register office, ready reckoner rates, property portals, bank auction notices, circle rates, builder price list. This method is best suited for residential plots, residential buildings, commercial shops and offices where active market exists with verifiable comparable sales data. So by using this method, 3 to 5 verified comparable transactions of more or less same period, say 6 to 12 months of same locality are used. Elements of comparison and adjustments. So the properties are unique. Every property is unique. So this some adjustments are made as per the property's attributes, depending on real property rights, whether it is freehold or leasehold, encumbrances, easements, financing terms, whether it is distress sale, forced sale, or it is fair value arm's length transaction, conditions of sale, whether it is related party transaction or motivated buyer seller, and market conditions, time adjustments for market appreciation, depreciation, location. The most important concept is location, location, location. Where it is situated, road frontage, corner plot, direction, distance from node. The physical characteristics of the property: size, shape, topography, soil, dimension, frontage, land use and zoning, residential, commercial, industrial, FSI, FAR differences, non-realty components, personal property, business value included in sale. These are the elements of comparison and adjustments. Hypothetical plotting scheme development method. This is for valuing large undeveloped land parcels. Applied when a large tract of land has no direct comparable sales. The valuer hypothetically subdivides it into plots and calculates the residual land value. The hypothetical layout is prepared. Assume a development layout as per the norms and general practice, say about 60% for sellable plots, 15 to 20% for roads and open spaces, amenities remaining. Then market value of plots. Determine rate per square meter for developed plots in the area for comparable data. Gross sales realization. Sellable area into market rate. Development cost. Deduct layout, roads, approval cost, developers overheads and profit. It is 10 to 20% legal cost, marketing. Then the residue is land value. Gross realization minus all deductions. This is the indicated land value, and this is to be discounted to the present value by dividing the expected rate of return, the value divided by 1 plus expected rate of return whole square raised to number of periods of development. Then third approach is income approach to value. In valuation, income approach to value, this is most important concept. The value of a property is the present worth of future benefits, income it is expected to generate. Income approach is used when the property is income generating, like tenanted properties, commercial offices, retail shops, warehouses, residential flats with existing tenements, rent control properties, leasehold properties, special properties, hotels, cinemas, malls, petrol pumps, hill resorts. Investment analysis, yield comparison, real estate versus other investment. For that, internal rate of return, net present value, CAPM, capital asset pricing model you choose. The key concepts are, or the steps are: first, the gross rent or gross income is determined. Then the outgoings, this vacancy, taxes, repairs and maintenance, management. By deducting net income, that is net operating income, is worked out. This is divided by capitalization rate. It gives capital value of property. Or discounted cash flow technique. If there is variable cash flows in future, then this discounted cash flow is used for discounting to present value. The types of rent and outgoings. These terms are important, like market rent. This open market rental value, the willing buyer and seller, arm's length transaction, there is no restriction. This is fair transaction, that is market rent. Then standard rent. The standard rent is decided under the Rent Control Acts. It is less than the market rent. Contract rent. Rent actually passing under the existing lease agreement. Ground rent. Rent paid for use of land like MIDC, GIDC or industrial development corporations in various states in India. The standard outgoings are municipal property tax, repairs and maintenance, management charges, vacancy and collection loss, insurance premium, and sinking fund. This is annual provision for future development of building at end of life. So this capitalization is made by years purchase. Capital value is equal to net annual income multiplied by years purchase. This years purchase is found out when the income is perpetual. This years purchase YP is 1 upon remunerative rate of interest R. When the building is of finite life or lease term, then for that finite term this YP is worked out. So this formula is 1 minus 1 upon R raised to minus n divided by R. So this is one example. So this is YP perpetual. This example is net annual rent, capitalization rate. This net annual rent divided by capitalization rate. This gives capital value. In finite life, annual rent, remaining life rate, this YP as per this formula is, so this YP is a multiplier to arrive a value, today's value, capital value. So this can be worked out by using this formula, and there is function in open office, that PV function. By using this PV function also we can find out this PV is this rate of interest 8%. This is number of periods, years, 20 years, and this is yearly income. So by this formula also we get this capitalized value. So this in open office we will see how it works. Open office is a open license document, software, open source software, and it can be freely downloaded by going on Google and searching open office download. We can download in computers, laptop, and in mobile also. In mobile also there is application. So I suggest that everyone studying for this exam should use this open office, and this practice on open office, so that in exam it will be familiar. So this we were so this PV is present value is worked out 8% rate of interest, period 20 years, and 2,40,000. So this is PV 8%. In open office, instead of comma, we shall have to use semicolon. This C in it shows what input to give. PV first we have to give a rate of interest, or this discount rate. Then N per number of periods is 20 years. Then PMT, payment per year, 40,000. And then type and future value, these are optionals. So this is 23,56,355. So by using PV function we can find out YP quickly in exam. In sinking fund or in leasehold properties, there are two rates: remunerative rate of interest and accumulative rate of interest. For this sinking fund, accumulative rate of interest is used. The rate is risk free. It is generally 4 to 6%, and remunerative rate is rate of interest at which the investor expects return on their investment, reflects risk, location, property type. This dual rate of YP formula, as we know, YP dual rate is 1 upon remunerative rate plus an IC, annual sinking fund, and then accumulated annual sinking fund is found out by using this equation. For this also there is a open office function, future value. By using future value function, we can find out this accumulated amount, and to find this sinking fund coefficient, we have to use PMT function. This PMT function is when we take loan from banks, and there is installment, monthly installment. This installment consists of component of principal recovery and interest recovery. This combining both one installment based on rate of interest, amount, and period of repayment. This is determined. So likewise, by using this PMT function, this 4% rate of interest, 20 years, and we have to put 1 to get this sinking fund coefficient. Valuation of rent control properties. Rent control acts freezes rents for far below market levels, creating separate interest, the landlord's reversion and the tenant's occupancy interest. Valuation of landlord's lessor's interest. Determine standard rent, control rent passed under the lease, estimate full market rate for the property, identify rent shortfall, market rent minus standard rent, value of landlord's interest, YP limited term into standard rent, add reversion to full market value on termination, and valuation of tenants' leases interest. Tenant enjoys property at standard rent, that is below market. Tenant's profit rent is equal to market rent minus standard rent or contract rent. This profit rent has a capital value. Tenant's interest is equal to profit rate into YP dual rate for remaining tenancy term, and this together, lessor plus lessee's interest, is equal to freehold value of the property. There is discounted cash flow method in income approach. DCF converts all projected future cash flows into a single present value using an appropriate discount rate. Net present value. Net present value is calculated by discounting the discounting rate, and based on this net present value of the property and investment, comparing it with the investment, the profitability or viability of the project is decided. When NPV is more than or positive, investment is viable, and when NPV is negative, investment is not viable. At NPV 0, there is break even. And in Excel and OpenOffice, there is syntax function NPV, and you have to give range of numbers. Likewise, internal rate of return. This internal rate of return is the discount rate at which NPV is 0. If internal rate of return is more than required rate, accept the project. If it is less than, then reject the project. That means at what rate the investment is being made or the loan from bank we get, and what returns that project generates, that we are comparing after going all expenses and outgoings, and internal rate of return is calculated to decide the viability of project. Discount rate. This discount rate reflects risk-free rate plus property risk premium plus liquidity premium. Source for discount rate is market derived comparable investment yields. It is worked out by CA capital asset pricing model. Weighted average cost of capital is equal to cost of equity into weight of equity plus cost of preference shares into weight of preference shares plus cost of debt and weight of debt. In this, cost of equity is worked out by the equation risk-free rate RF plus beta into market rate RM minus RF. RM minus RF is risk premium. Profit method steps are: determine gross annual turnover from accounts or estimates, deduct cost of sales purchase of goods, work out gross profit, deduct working expenses, staff, utilities, marketing. It gives divisible balance, trading profit of the occupier. A portion is tenant share, profit and risk, plus rent and property. It gives rent, capitalize rent at appropriate rate. This gives property value. Properties where profit method is used. These are the income generating properties: hotels, resorts, cinema theaters, petrol pumps, shopping malls, hill resorts, likewise. The reconciliation of these approaches: the cost approach primarily when no market data, specialized unique assets, insurance, new construction. Secondary for all others. Market approach is used primarily when active comparable markets exist, residential plots, commercial shops, most preferred when data is available. Income approach is primarily when income producing or generating properties, investment property, tenanted commercial properties, and this reinforces market approach. Valuation report must document appropriate approaches considered, why specific approach was primary, how weight was assigned in reconciliation, and any assumptions and caveats. So the valuation shall be done by using one or all the or one more than one approaches, and the valuer shall decide the final value as per his judgment. It may be by using one method or combination of methods, by giving weightages with justifications. The purposes of valuation are the valuation is carried out for bank finance, mortgage, stamp duty registration, insurance, rent fixation, court disputes, mergers, acquisitions, sale purchases, capital gain tax, insolvency and bankruptcy, IBC code, partition, probate, distribution among heirs, lease and surrender of lease, lessors and lessees interest, premium for surrender, differential rent. Likewise, there are valuation standards for carrying out this valuation. The main is international valuation standard. Then in our country there is Indian accounting standard, Ind AS. So these are the various standards. Ind AS 16 for property, plant and equipment, then Ind AS for 40 investment property, Ind AS 36 impairment of assets, 113 fair value measurement. Then there are case laws. So the case laws shall be discussed at length. This has a coverage of 2 marks, and based on this case laws and judgments of Supreme Courts. The valuation principles are have taken shape. Valuation report structure and contents. Professional standards for reporting. The engagement and instructions, client identity, purpose of valuation, basis of value, date of value, effective date, subject property details, its location, description, ownership history, title details, encumbrances, legal status. Then market analysis, macro and micro market overview, supply demand analysis, recent comparable transactions, site and building inspection, location, physical inspection findings, sketch photographs, area computation, construction quality, valuation analysis, approach selected with rational assumptions, data use calculations, reconciliation, value conclusion, final value figure, caveats, limiting conditions, confidentiality clause, compliance statement, independence declaration, IBBI registration number, RVO members, IVS complies, and annexures, site plan, title documents, copy, photographs, comparable, sale data, fee schedule, etc. The valuation report should contain all this. And every care shall be taken while valuing the assets, even though the paper verification or document verification, ownership verification is not responsibility of valuer. There should be special mention regarding that note. But valuer should try by keeping his eyes open to see all the aspects of the structure, so that there will be no trouble to anyone in future. Professional ethics and code of conduct. This is as per company's registered valuer. This is by find and replace, that mark of rupee has come. So the professional ethics and code of conduct. Independence of valuer, no conflict of interest with any party in the transaction, must disclose all interest upfront. Professional competence, accept assignments within your area of expertise and qualifications. Confidentiality, client data must not be shared without consent. Information security obligations. Integrity and fairness, value opinion must not be influenced by the desired outcome of the client. No value shopping. Due care, thorough inspection, data collection, analysis before forming and reporting value opinion. Disclosure of interest, any financial interest in the subject property or relationship with parties must be disclosed. Valuer must visit the property. He should take photographs of the property, timestamp photographs, timestamp and geotagged. Nowadays in mobile we get geotagged and timestamp photographs. So valuer should take photographs along with property, and the photograph should be submitted with the valuation report. Also the dimensions of the property shall be measured. Photographs from inside, outside and surrounding shall be enclosed. Also the representative of bank or owner, along with him the photograph shall be taken to avoid any disputes or court matters in future. Then insurance valuation and loss assessment. For insurance, the reinstatement value is important. Insurance valuation is not market value, it is the cost to reinstate the property to its original condition after a loss event. The key insurance concepts are: sum insured, the amount for which property is insured, should equal reinstatement value. Reinstatement value means full replacement cost without any deduction for depreciation or obsolescence. When the policy is full reinstatement value, the deduction for obsolescence or depreciation is not made. The full value payment is made if loss occurs. Indemnity clause or indemnity value, market value at the time of loss after depreciation, used in non-reinstatement policies. Under insurance, if sum insured is less than the reinstatement value or the property value, the condition of average clause applies and claim is worked out as sum insured divided by reinstatement value into loss. Over insurance, sum insured is more than reinstatement value. The insurer pays only the actual loss indemnity. This is indemnity principle. Principles of insurance. Insurable interest. The insured must have a financial stake in the property at the time of loss. Utmost good faith. Full disclosure of all material facts by both insurer and insured. Indemnity. The insured is restored to the same financial position as before the loss and not more. This insurance is not profit, should not be profit making. Subrogation. After paying the claim, the insurer steps into the shoes of the insured to recover from third parties. If accident happens, the accident making other party, that it can be sued in court and the loss can be resumed. That is subrogation. But this is after paying the insurance to the insured. Proximate proximate cause. Only the immediately effective cause of the loss determines the payability. The proximate cause is important. As we are aware that this is the IBBI regulatory framework, the legal basis is Section 247 of Companies Act 2013, Companies Registered Valuation Valuer and Valuation Rules 2017, IBC 2016. In this, IBBI regulates the valuation profession, sets syllabus, issues certificates, monitors and inspects valuers. There are various RVOs throughout the country. Those recognize this these recognized valuer organizations as our CEV IAF and others ICAI. And this is about chartered accountants. Those conducts 50-hour program and continuous CEPs, continuous education program. The RV exam, NISM administered 2-hour MCQ exam, 60% marks, 25% negative marking, and passing is 60%. It is available every working day. Registration, IBBI issued certificate of practice must be renewed periodically. CEP continuing education required 16 hours per year. Under IBC, 2 independent registered valuers are appointed by the resolution professional. Their average is the fair value and liquidation value used for the CIRP processes. In CIRP, both the values shall be given by the registered valuer. And 2 registered valuers are appointed. They have to give the fair value as per going concern business and liquidation value. Because if the CIRP process fails, then the business goes into liquidation. So both the values are called. The registration of registered valuers, registered valuer entities and registered valuer organizations. So the qualification for registered valuer is graduate plus 5 years experience or postgraduate plus 3 years experience, and in securities and financial assets for CA and MBA 3 years experience is required. This there are various forms for registration. Form A for individuals registered valuer, application fee is ₹5,000. Form B is for partnership firms with application fee 10,000. In Form C, registration to individuals and partnership firms is given. Form D is for application as RVO registration. The application fee is 1 lakh rupees, and Form E, the recognition to RVO is given by IBBI. Here is one mistake, I will correct that. These committees are given below. The committees at RVO. There are optional and mandatory committees. The optional committee is advisory committee, and mandatory committees are membership committee, monitoring committee, grievance redressal committee, disciplinary committee. In disciplinary committee, there should be at least one member from authority, that is IBBI. As per clause 27, the temporary surrender of membership can be done. It is advised to read all this from this IBBI rules. all the clauses. Then clause 30, expulsion from membership ineligible under bylaw 9 on expiry of 30 days from order of disciplinary committee, non-payment of fees and at least 2 notices served in writing, registration cancellation by court. The fundamental principles of valuation are ethics, integrity, objectivity, professional competence, due care, and confidentiality. As we already have seen these formulas, there is a chapter of business environment analysis. So this business environment analysis, there are various models. Then first is global economy, industry and company analysis, GEIC analysis. This is traditional top-down fundamental analysis framework used in equity research, business valuation and security selection. It systematically breaks down external and internal factors to evaluate the intrinsic value of a business. Then Porter's 5 forces strategic analysis model. These 5 forces are competitive rivalry, new entrants, suppliers, buyers and substitutes, to help business assess industry attractiveness and shape their competitive strategy. Then SWOT analysis, strengths, weaknesses, opportunities and threats. This evaluates internal and external factors. The strengths and weaknesses are internal factors and opportunities and threats are external factors. Then PESTEL model, political, economic, social, technological, legal, environmental, are complementary business strategy frameworks. Maps broader macro fundamental forces. Used together, they offer a complete view of a company's market position. Then BCG matrix. The BCG matrix is on vertical axis there is market growth rate and horizontal axis relative market share, and it is divided as when the relative market share is low and market growth rate is low, then the business is termed as dogs. When relative market share is low and market growth rate is high, there is question mark. So the more investment shall be made to generate cash. Then when the relative market share is high, it is a well settled business, and market growth rate is low, then this is cash cow. Like Geo has maximum relative market share up to more than 50%, and the growth rate in the sector is now stagnant. So it is generating the cash. So it is a cash cow, and this is when both are high, it is star, means there are growth opportunities and more investment can be made in that business to generate more cash. Then G McKinsey matrix, it is with industry attractiveness and business unit strength. When business unit strength is low and industry attractiveness is low, then it is suggested to harvest, to wind up the business. When it is average, hold, and when it is high, it is grow, invest more and grow. There is economics chapter in the syllabus, microeconomics and microeconomics. There is gross domestic product. This gross domestic product is total production of goods and services within country borders. Gross national products, it includes income from citizens abroad. That is, it includes GDP plus net factor income earned by nationals abroad. Less factor income earned by foreigners domestically. Net national product, gross national product minus depreciation. Disposable income for spending is income minus tax. Fiscal policy, this fiscal policy is announced by Ministry of Finance of country This is macroeconomic policy affects employment, inflation, growth. This is expansionary and contract. It may be expansionary or contractionary policy. Country like India, there is a deficit budget and always expansionary uh, policy, because we are a more population country, and there is requirement of job generation and growth of industries and all infrastructure. Then the fiscal policy, it is announced by Ministry of Finance. This gives macroeconomic policy, affects employment, inflation, growth. This is expansionary contractionary policy. Then expansionary policy means used to stimulate economic growth during recessions. The government increases public spending on infrastructure and lowers taxes to put more money into hands of consumers and business. Contractionary policy uses to cool down an overheating economy to lower inflation. The government decreases public spending and raises taxes to slow down economic activity and reduce aggregate demand. The fiscal deficit is total expenditure minus revenue plus capital receipts. This signifies overall borrowing needs. Revenue deficit, revenue expenditure minus revenue receipts. It signifies operational surplus. Primary deficit, fiscal deficit minus interest payment, signifies current fiscal imbalance. Monetary policy is given by RBI to control money supply and interest rate stability, growth and inflation control, with 6 tools: CRR, SLR, repo, reverse repo, bank rate, open market operations. The businesses has life cycle, as there are substitutes and technology changes day by day. So the business cycle is expansion, then peak, then contraction, then trough, then again recovery with the introduction of the new technology. So this is business cycle. There is interest rate parity theory. The forward rate of two countries depends upon interest rate of these two currencies. Interest rate differential is approximately equal to premium discount of a currency, where forward rate is equal to spot rate in terms of rupees and dollars, and its quotient of periodic inflation rate. Then Fisher's formula is 1 plus real interest rate into 1 plus inflation rate is equal to 1 plus risk-free rate. Real interest rate at which inflation is not adjusted, and risk-free rate, treasury bill instrument issued by RBI. International Fisher's effect is inflation rate differential is equal to premium or discount of currency. Purchasing power parity theory. Price of any product will be same in any country depending upon its currency. Arbitrage pricing theory. Multi-factor asset pricing model. Expected returns are function of microeconomic factors and systematic risk variables. That is expected returns, risk-free rate, beta, premium of risk factors, etc. Principle of substitution. A buyer will pay not more than the cost of an equal, desirable and comparable alternative property. There is one correction. There are ratios in accounting, that liquidity ratio, solvency ratio, activity ratio and profitability ratio. By looking this ratio, we can judge the functioning of the business, and there is 2-mark question in exam based on these ratios. The golden rules of accounting, in case of personal account, real account and nominal account. Then there are 3 types of cash flows: operating cash flow, investing cash flow and financing cash flow. This cash flows coming from operations, main core operations of the industry, then by investment and by financing. So this, in 3 categories, these cash flows of the company are divided, and by summing up, the profitability of the business is decided. But the most important is operating cash flow, because what are the main core business of the company, it is reflected in operating cash flow. The investments made in assets, capital assets, and other assets, it is reflected in investment cash flows. And when this financing cash flows, the financing, the debt rates, or the amounts investment, that cash flow is shown in financing cash flow. There is a chapter of call and put option trading. So this uh, calls and puts, there are option trading strategies, that long straddle, long strangle, then bearish bullish strategies, long strip, long strap, butterfly strategy, condor. So one should study these strategies. So its coverage is very big, so those should be studied carefully. A caller of a floating rate bond, there is a mention of bond also. The caller of a floating rate bond refers to the minimum and maximum strike rates for coupon. Then there are various acts for legal framework for valuation, that the Income Tax Act, that covers gift tax, then double taxation avoidance agreement, Transfer of Property Act, transfer of movable and immovable property, property sales, mortgages, leases, exchanges, and gifts. So for that, this Transfer of Property Act 1882 is there. As per this act, living person includes any company, incorporated or not, association or body of individuals. Then there is SURFACE Act 2002, securitization and reconstruction of financial assets and enforcement of security interest. It is applicable from June 2002. Earlier there was Companies Act 1956, then Recovery of Debt Act 1993. So it is for recovery of debt and securitization. Then this is IBC, the CIRP process, its timeline. In real estate, how CIRP works. Then voluntary liquidation, when not committed any default, audited financial statements of last 2 financial years, valuation of asset report, special resolution. 2/3 creditors in value must approve resolution within 7 days. Liquidation commencement date is date of resolution. The Limitation Act 1963 does not apply during moratorium period. When this IBC, the CIRP is going on, there is moratorium in that company. Its appeal can be made to NCLAT in 30 days and then extension of 15 days. If it is not satisfied, then appeal to Supreme Court in question in law in 45 days with extension of 15 days. The waterfall mechanism under IBC. There is one question from this waterfall mechanism. When this IBC CIRP process is done, then how the amount found out by this process is distributed. This is waterfall mechanism. The insolvency and liquidation costs. First, the insolvency and liquidation costs are recovered. Then workman's dues and secured creditors. Workman's dues for the 24 months preceding the liquidation commencement date and debts owed to secured creditors who are relinquished their security interest rank equally here. Then third rank is employee dues, wages and unpaid dues owed to employees other than workman for the 12 months preceding the liquidation date. Unsecured financial creditors, financial debts owed to unsecured creditors. Then at fifth rank is government dues and unpaid secured amounts for the 2 years preceding the liquidation and the unpaid portion of debts owed to secured creditors after they enforce their security interest. Any remaining debts and dues at priority 6. Then preference shareholders, and last at 8th rank equity shareholders and partners. The final residual amount goes to equity shareholders or partners, if any. Then there is Indian Stamp Act, how the document should be stamped and what stamp duty should be used. There is one question regarding this Ind AS accounting, Indian Accounting Standard 113 cannot be used in Ind AS 36 to 102 and 116. There is Foreign Exchange Management Act 1999, External Commercial Borrowings governs FEMA 1999. These are the Indian Accounting Standards various. The structure of valuation report we have seen. It includes should include sensitivity analysis. What is sensitivity analysis? The sensitivity analysis is by varying the uh, variables the what is the effect on the value of the property. The value of the property is based on various variables. By changing those variables, how the property cost varies. So this sensitivity analysis shall be enclosed with the valuation report, as when the DCF discounting rate is changed, or the growth rate forecasted is changed, then the revenues changes in revenues likewise. The important formulas, as we have already discussed, these are enumerated here. This is depreciation curve comparison, the straight line method, the blue, the black, and in red written down value method, and in blue sinking fund method, as we already discussed. These are the some formulas. Thank you.